There's an old Wall Street adage, sell in May and go away, which suggests that you would have been better off historically selling your whole equity portfolio each May and then buying it back in November. I'm Seth Freuberg, the head trader of S&B Capital's options trading desk here in Manhattan, and we hear ideas like this bouncing around all the time, and they actually provide us with trading ideas that you might not have thought of initially if you didn't have a background in options trading. In this video, we'll take a look at handling May through November in a very different and far more profitable way through the use of an easy-to-learn options strategy. So if that sounds interesting to you, then stick around because I think you're going to find this eye-opening. Hi, I'm Seth Freuberg, and I'm the head trader of S&B Capital's options trading desk. S&B Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. As the old saying goes, sell in May and go away. And there is some mythology around that we'll talk about in this video. But the first thing I'd like to do, which I think is an important takeaway from this video on its own, honestly, is to share with you a quote from the chief U.S. equity strategist at Credit Suisse, Jonathan Golub, who recently pointed out that any investment strategy that you can summarize in a rhyme is probably a bad strategy. And I'd say I probably agree with that. And so that got us to thinking about what may be a better way of looking at things. And so, first of all, let's get the record straight by pointing out that, in fact, I'm not sure that sell in May and go away is such a great strategy in any event, because, in fact, since 1896, the Dow has averaged a gain of 7.3%, with a 2.1% of those gains coming from the May through October period of time. So if you actually followed that little rhyme, you would have reduced your returns by 28% long term. So the whole thing is pretty questionable, but in any event, it did bring out something that does seem to be on average true. And that is that the market does on average perform in a lackluster way from May through October. And that's particularly true in years where there was a big rally overall in the market, something like what we've experienced so far in 2021. So we have started to think, was there a better way to approach the May through November period through the use of option strategies? And the answer in general looks like that's a pretty strong yes. And you'll see why that's the case in a minute. But before we get into that, I wanted to let you know that if you'd like to learn 3 option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on direction, then click the link that should be appearing now at the top right corner of your screen. That will open the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause this video, sign up now, and then resume watching. Okay, so to explain how this strategy works, we need to make sure that everyone watching this video understands how index options work, so we're going to do a really quick review of them. And for those of you familiar with how they work, just hang in there. This will be really quick, and then we'll jump back into teaching you this different way to handle that May through November period. All right, so the best way to understand index options is to think of them as bets. What are known as call options pay off if an index closes above what's known as the strike price of the option on the day that the option expires. If the index does close above that price on expiration day, then the call buyer gets $100 per point that the market closes above that call strike price. A put option is the exact opposite. It pays off if the market closes below the strike price of the put option. Again, $100 per point that the market closes below the strike price of the put. So for example, if an index closes at 4,032, then the 4,000 call would pay $3,200, as you can see from the calculation, because the index closed 32 points above the strike price of the call, which is 4,000. However, the 4075 call would expire worthless as the index didn't close above 4075, so the call seller just pockets the premium. And the puts are just the opposite. If the market closed at 4032, then the 4075 put would be worth $4,300 because the market closed 43 points below that put strike price of 4075. But the 4000 puts would expire worthless because the market did close below the 4000 strike price. So with that as background, we'll get back to the average lackluster performance of the market between May and October. And so when options income traders think about lackluster performance, one of the first things that comes to mind is a strategy known as the Iron Condor. And so let's go back to 2015, and as you can see, the market had run up quite a bit over the previous 2 years. And so this is a typical environment in which the market takes a breather during the May to October period. So suppose that on that day, you sold 10 December 31st SPX Index 2350 calls and bought 10 of the 2400 calls, also expiring in December, while simultaneously selling 10 of the 1650 puts while also buying 10 of the 1600 puts, again, expiring on the last day of the year. Well, if you did that, you'd be executing what options traders refer to as an Iron Condor trade, which in this case expires 8 months later. And the strikes were picked mathematically based on what options traders call options deltas. And in this case, we sold the call and put options at what are known as 10 deltas and bought flanking long calls and long puts 50 points above and below those, as you can see. Now, let's first look at how the cash flow works on this trade. And as you can see, when you sell those 10 2350 calls, you receive a premium of $6.60 for them. But remember, each point that the SPX closes above 2350, you'd owe $100 on those. So you multiply that by 100, and you sold 10 of those. So if you do the math, you receive $6,600 for those. Now, with that same logic, you'd pay a total of $3,150 for the protective 2400 calls. You'd also receive $22,700 for the short puts at 1650 while buying the 1600 puts for $18,650, resulting in a total cash inflow of $7,500. Now, to enter into this trade, you should note that your broker is going to require you to have $42,500 in your account, and that also represents the worst case scenario on this trade. Okay, so now let's move forward to October 30th, the last trading day in the May to October timeframe. And as you can see, and I admit this is a little fluky, the SPX was trading towards the end of that final day of the month, almost exactly where it was trading when we opened the trade at 2086. And on that day, it was trading at 2083. And so the market basically didn't move at all. And so here's what that Iron Condor looks like 6 months later. And so let's do a comparison and look at the pricing of those same options on October 30th. And as you can see, each of them have dropped in value significantly, more than 90%. Now, why did that happen? Well, think about it. If an index doesn't essentially move for 6 months, then what's going to happen to the pricing of those options? You see, when the trade first started, the chances of the market moving up to 2350 from the original price of 2086 were way higher at the end of April than they were at the end of October. Why? Because there's just less time for that to move up to 2350 to activate the value of the short 2350 calls. And by the same token, there's again just less time for the market to move down to 1650 to activate the value of the short 1650 puts, because that 436 point drop down now is just a lot less likely to take place in 2 months as it was to take place in 8 months when we first put the trade on. And so if the market's basically at the exact same place, just because of the passage of time, those options have lost their value. And that's what options traders refer to as time decay. And so now, if we go ahead and close that Iron Condor trade on that day, let's take a look at what would have happened. And as you can see, to close an Iron Condor, you buy back the options you've sold and you sell the options you've bought. By doing that, the position is fully closed. And so, as you can see, starting with that original positive cash flow stemming from that original Iron Condor trade back on April 30th, and then adding the pricing we paid for buying back the 2350 calls and selling the 2400 calls while simultaneously buying back the 1650 puts and selling the 1600 puts, you'll see when you add it all up that the result is that out of that original $7,500 of positive cash flow, we're left with almost all of it after closing the trade for a profit of $6,800, which is a 16% return in 6 months. So we did the same thing looking at the 5-year period of 2015 through 2019 under the assumption that the market was so wild in 2020 as a result of the pandemic that the potential for a massive bounce off of the crash was too great to risk a 6-month neutral style option strategy like this. And so that would have suggested it wouldn't be too smart to necessarily use a strategy like this in such a rare kind of a year. So we looked at the more normal markets of 2015 through 2019, and we found that in each of these years that we entered into these same 10 delta iron condors with the short and long calls way above the market and the short and long puts way below the market, all expiring in December, that when we closed each of these 6 months later at the end of October in each of those 5 years, then here would have been the results. And as you can see, the results were pretty astounding with a total return of 63% with one small losing year and a 12.6% average return over those 5 years. When you compare that to what we mentioned before, that average 2.1% return during May through October on the Dow throughout the history of the stock market, this not only outperforms that more than 5-fold, but it even crushes the market's annual return historically, which was 7.3%. And so the important takeaway from today's video is not so much that the return on a period of time can be exponentially increased by options trading strategies, but rather that options traders have tons of tools available to them to address different market conditions. And so when we become aware of a period of time where the market tends to be flat and lackluster, we have a tool, the Iron Condor strategy in this case, to take full advantage of that kind of time frame and turn it from being a lackluster return and a poor use of capital to a period where tremendous returns are possible, whereas flat out being long equities would have yielded next to nothing. With the expertise that options income traders possess, these kinds of opportunities become obvious and second nature, and you suddenly have a way to make money when the market isn't moving at all that can be extremely powerful to have as an important component of your trading playbook. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it, and please don't forget to click on the subscribe button right now so you won't miss all of the free trading videos that we're posting constantly on our channel to help you to improve your game as an options trader.